You know, if you consult a nutritionist and ask about what you should ideally be eating every day, more often than not, you'll be advised to have a balanced diet. You need a good share of carbs and protein, but a little bit of sugar is not bad either. Similarly, it's said that in your investment portfolio, diversification is a good strategy to follow. And that brings us to multi-asset funds. My first guest today will tell you everything that you need to know about it. Santosh Navlani, Chief Operating Officer of ET Money, is joining us. Thank you so much, Santosh, as always, for taking the time. Good evening to you. Let's start with the most basic question. What are multi-asset funds?
So I love the analogy, Alex, you gave about the balanced diet. I think everybody wants one, but rarely people get one. But unfortunately, in mutual funds or world of investments, it's not as tough. And I know the moment we get to know how to go and buy it. Typically, individual investors like you and me have only a few asset classes at our disposal: equity, debt, gold, real estate, maybe crypto these days as well. One of the difficult part about investments is when to buy what asset class in how much proportion. And if you want to really outsource this job to a fund manager and actually go and aim for steady returns, balanced returns in every kind of market, short term, medium term, long term, then multi asset funds are your best bet. They actually give you exposure to three asset classes into one fund. So I typically call them like three in one fund, so to speak. It's like you actually have domestic equity allocation in them, you have gold, you have debt. And the fund manager, depending on the market scenario, actually either increases allocation specific asset class or reduces or basically maintains a minimum allocation each of them and creates a very steady and balanced returns experience for people. As per SEBI's definition of multi-asset funds in the country, any fund which actually maintains at least 10% allocation to each of the asset class of equity, debt, and gold is classified as multi-asset fund. So you would typically find a lot of funds in the space who actually are sometimes running more of quasi aggressive hybrid fund by having a lot of portion towards equity. In all market scenarios that may not be good, but so to speak, people have allocations possible in all these asset classes into one fund called multi-asset.
Just those three, right? Fund managers have taken the liberty to expand that to other assets as well. Could you also take us through some of the other assets that have been invested in and the forms that they're invested in?
Yeah, so some of the funds, I think SBI and Nippon, their respective multi-asset funds actually have interestingly allocation to international equity as an asset class as well, which is amazing in that sense. People actually get benefit of almost four in one asset class. They're actually three, but the version of equity can be domestic and international as well. So Nippon actually has about 20% allocation towards international equities in their multi-asset fund. SBI has some allocation. There are some assets, some fund managers actually having interestingly InvITs and REITs as replacement of fixed income or real estate as an asset class as well. So there are interesting kind of fund offerings to go for. But ultimately, one looks for steady returns, and it can be a combination of three asset classes or four asset classes. But the result is going to be same. More of a steady returns in all kind of market scenarios. There is one more fund in the marketplace by Motilal Oswal Mutual Fund Company, where they actually have this interesting passive way of building a multi-asset portfolio where they have two options for people: an aggressive fund of fund and a conservative fund of fund. They are not classified as multi-asset funds, but they actually are multi-asset fund in scenario where they allocate fixed static allocation towards Nifty 500 index funds, S&P 500 index fund of US, domestic GSEC for fixed income, and 10% allocation to gold as well. As of now, the international investments are stopped, so this fund is not accepting allocations, but it actually is a great replacement for multi-asset fund as well.
Why would you use a multi-asset? I think to a certain extent we have spoken about the use case, but why would an individual look at a multi-asset fund? What place would it hold in an individual's portfolio?
Yeah, so Alex, I think all of us are running multi-asset portfolios in our own monies. If we go and introspect deeper, all of us or most of us would have some allocation towards equity, and either in the form of direct equities or mutual funds. We will have allocation towards fixed income via fixed deposits, bonds, or maybe debt mutual funds. We'll have allocation to gold by having physical gold in our homes, or maybe digital gold or digital or gold mutual funds, as we can call them. And we'll probably have allocation towards real estate as well, maybe in the form of REITs or having physical land or our houses. The fact is, we are all running multi-asset portfolios unknowingly. Just that when you bring some structure to it, it actually can do much better job to your investment portfolio than that. And multi-asset funds actually do that job of organizing your investments into different asset classes in a right strategy. And there is a reason that you should have this approach or diversified balanced portfolio always in life, because not all asset classes rise together and fall together. In fact, equity is negatively correlated with gold and debt, or rather debt and gold are negatively correlated to equities in that sense. So when equity typically is in bull phase, chances are very high gold is not rising along with equity. When equity is in a kind of bust phase, or it is falling like a crazy market as we saw in last few days, you would probably see gold outperforming. In fact, if you see last 6 month returns, just as an example, Nifty has given a negative return of about 6 percentage points, if I can say that, and gold probably has given about 10% positive return. So we basically have seen in reality right now it's shaping up where gold actually has given a positive return where equity is not. So typically when you access the reality that all asset classes are not positively correlated, some of them are negatively correlated. And if you want a steady experience where in your portfolio there is somebody who's giving you returns while somebody is giving stability, or somebody is giving you returns while other asset classes falling, then multi-asset funds actually do that job pretty well for you.
Uh, and just to elucidate your point, over the last couple of years, when you've had a bull run in global equities because of easy monetary policy, you've had yields that have been subdued, and therefore fixed income has not given you the kind of returns. Maybe towards the start when yields were falling, that was good, but by and large, debt funds have not done as well as they've done in the past. And on the other hand, you had equity that has outperformed. But why don't we roll back and take a longer view of things, Santosh? Over the longer period, would you still say that multi-asset has done its job, has outperformed?
So, Alex, as of now, India is just seeing a kind of entry or other interest in this category. I'm sure products will get better. Uh, but if you look at the objective behind these funds, it's actually quite noble. They are neither equity funds nor they are debt funds. So what does it mean? Like, debt funds typically will only protect your purchasing power, if not just beat inflation by a slight amount. Equity as an asset class gives you long-term wealth creation potential, where you actually are trumping inflation by almost double-digit return in that sense, or a very high single-digit return in the long run. But when equity comes with a lot of ups and downs, and debt basically has a steady kind of protection of purchasing power at max. What does multi-asset do? They exactly fall in between. By combining multiple assets into one fund, they actually hope to, or rather aim to give you somewhere in exactly middle of equity and debt kind of returns. So if you really want, and if you really want returns which you want, like you are looking for debt plus returns, but not at the cost of ups and downs of equity, then multi-asset funds are pretty good job for you. They do pretty good job for that aspect. So if you it's basically somebody expecting or prioritizing a steady return, and deprioritizing ups and downs that come along in equity returns. And again, we can take a step back, as you mentioned, for over long run. And we've spoken about this in the past as well. If you look at 2008 global financial crisis, it didn't matter whether you had the best equity fund or the best stock. What mattered whether you had gold in the next subsequent years in your portfolio, where gold actually had a secular bull run for almost 3-4 years together, and it gave a phenomenal return to people who were investors in gold. It's the same thing happened in the 2020 as well, where while equity markets actually were probably flattish, or very small single-digit returns depending on the fund you bought. But gold as an asset class actually gave you almost 20% return in 2020. Why? Because when the markets were falling like crazy in February and March, gold actually became a safe haven and a hedge for many of the people as a asset of last resort, and gold actually gave very good returns. So what happens is you would not know as an investor which asset class is actually going to bear the brunt of a bull run in the end, or what kind of asset class is going to sort of see certain disinterest, and being at the mercy of an asset class to give returns for your portfolio in real life. You are better off by having a diversified approach to your investments, and multi-asset funds can do a good job, though you can build your own multi-asset strategy and run it in a very strategic manner or a organized manner, and probably get better returns for yourself than multi-asset funds as well.
Okay, I get that. But if you were to say that you are going to utilize multi-asset funds in your overall strategy, we've often talked about layering your investment portfolio. On the equity side, you're talking about a core versus a satellite allocation, right? But in this case, because you have allocation to multiple assets, strategically, what part of your portfolio would it fill? Would it be the core of your portfolio?
Given the way multi-asset funds are run in the country, I wouldn't really go and say that they should become core part of your portfolio, Alex. While the intent is right from a regulatory structure standpoint, that provide an option to investors where at least 10% of the assets are invested in each of the asset class of equity, debt, and gold, and maybe international as well. What happens is the moment you run these funds as focused on one asset class of equity with bias towards equity all the time, they start giving you more or less same kind of ups and downs experience for investors. And if gold is always just lying 10%, then you're not really buying a multi-asset portfolio. You're just basically allocating some portion of your money to kind of, as a currency risk, a hedge against currency risk, and a hedge against inflation kind of stuff. So they may not be at a state where you can actually look at them as a core part of your portfolio. One can look at that aspect as a way that if you want to allocate 5% of your portfolio to gold instead of buying gold, you may be allocating like some percentage higher than that as a multi-asset fund, and you'll get a experience of fixed income, equity, and gold in your portfolio. So I wouldn't say core yet, but yeah, this can become a good strategy for you to really protect some part of your portfolio and aim for a steady return in the long run.
When we were discussing what asset classes these mutual funds invest in, and since it's an active strategy, mutual funds have different interpretations of what a multi-asset should be. So therefore, from the perspective of the investor, how would you go about choosing the fund that you want to invest in, and what are the parameters that you need to bear in mind? Because each one would approach, for example, equity investing also differently. They might have a different strategy, right?
Yeah, so if typically multi-asset kind of funds would not be advisable for short-term investments, because you wouldn't know which asset class performs better in the short run. And because these are typically debt taxation structure, you may be advised to really invest in at least 3 years or more horizon. So when you look for that kind of longer term horizon, like 3+ years, maybe sometimes 5 and 7 years for these kind of funds, you would typically want a diversified equity experience, Alex. And one should not be basically selecting a fund which is being run for equity part as large cap fund all the time, or debt portion of the fund is actually having aspects towards taking more of an interest rate risk in the portfolio. So if this fund's objective is run a steady ship, then you should look for a fund which has a location of equity as more of a flexible, like a flexi cap fund approach to it, where you have mix of large cap, mid cap, small cap without any kind of biases. You should have allocation towards debt in a way where the fund manager is not taking interest rate risk too much in the portfolio, or rather aiming for even having any amount of credit risk in the portfolio. So a good diversified approach to fixed income investing and equity investing is what you should look for as a fund. And a fund which actually is only allocating to gold as 10% in irrespective of all market scenarios, then this basically is not a good fund for you, because then the entire purpose of creating some kind of alpha in your portfolio by increasing allocation to gold at the right time, or when the market mood is in favor of gold, and you're only stuck at 10% in gold, then it will not be a good experience for you. You may not really get what you hoped for. So look for a fund which actually is running a very dynamic strategy across all these three asset classes, actually allocating or decreasing kind of exposure to gold with respect to market conditions will be good. And one of the ways to look at that is compare the annual returns of each of the funds in the marketplace and see that which fund has at least been able to beat fixed income return in each of the periods or maximum periods. That means if a fund has beaten fixed income returns or debt mutual fund returns in each of the calendar year periods, then you can actually expect or hope that this fund is being run as a multi-asset fund. And that one of those are the three or four checks you would probably look for in selecting a fund.
I think that we've covered all of the bases. Santosh, as always, it's been an insightful conversation. Thank you so much for joining us and have a lovely evening.
Thanks, Alex.